Let's jump right into this explainer. If you've placed a trade lately, you've probably felt it, that absolutely sickening knot in your stomach, right? You followed all the rules, drew your lines perfectly, waited for confirmation, pulled the trigger, and then literally watched the market just brutally reverse against you. Well, the source material we're diving into today addresses this exact incredibly painful experience. So why do your perfectly planned trades seem to fail with such malicious precision? You know the drill. You place your stop loss exactly where every textbook and popular tutorial tells you to, tucked right below the obvious swing low. And what happens? The price wicks down, it hunts your stop loss, triggers it, and then instantly skyrockets in the exact direction you predicted in the first place. But here's the fascinating reality check from the research. You weren't actually wrong about the trend. You read the market bias perfectly.
The harsh truth? Listen to this. You're just being used as exit liquidity. The larger participants simply needed your opposing orders to fill their own massive positions. It's crazy to think about, but retail traders usually don't lose because they pick the wrong direction. They lose because they're trading on public information that's been meticulously engineered against them. That pristine double bottom, the textbook trend line, according to the research, it's a trap.
To fix this, we need a massive mindset shift. Here's our roadmap for today's explainer. First, the retail liquidity trap. Then, defining true order blocks. 4 rules of execution, the inversion model, multi-time frame alignment, and finally, trading like an institution.
Let's kick things off with Section 1, the retail liquidity trap. You have to ask yourself, why do institutions even do this? Well, banks and hedge funds literally cannot execute a $100 million position all at once. If they tried, they'd cause catastrophic slippage. They desperately need liquidity, and to get it, they essentially manufacture it in 3 distinct steps. Step 1 is consolidation and an impulse break. The market drops below a swing low, and boom, retail FOMO kicks in. Then we hit Step 2, the emotional entry. Retail traders short the market at the worst possible price, tucking their stops just above a local high. And finally, Step 3, the institutional trap. Smart money algorithms spot that heavy pocket of retail stop losses, which remember are just buy orders. They absorb the initial retail sells and then drive the price straight up through those stops, completely sweeping the liquidity they need for their real move.
Moving on to Section 2, defining true order blocks.
To really get this, we've got to drop the amateur social media definitions that are probably costing you money. We need to look at this strictly through structural market mechanics. Look, an order block is absolutely never just the last candle before a move. That is such a dangerous oversimplification. A true order block is the exact institutional mitigation zone where large-scale players accumulated positions before driving structural displacement. The source material uses a really great analogy here. Think of it as a ledger entry. When an institution wants to go long, they actually sell first to drive the price down and trap weak sellers. That last bearish candle, that is the exact footprint of where they trap those opposing orders. Later on, when the price comes back to this zone, they're essentially testing their own ledger to mitigate risk.
All right, Section 3, 4 rules of execution.
So how do we actually trade this reality without letting our emotions take over? We have to shift to objective math. The source gives us a holistic framework made up of 4 absolute rules required to execute an order block trade. We've got the displacement requirement, the mitigation zone definition, the equilibrium entry model, and the volatility-based stop loss. Let's break these down one by one.
Rule 1 is super strict, and honestly, it kind of blew my mind. It's all about the math of displacement. An order block is totally invalid unless it's followed by a displacement candle body that's at least 1.5 times larger than the preceding 20-period average true range, or ATR. This is crucial because it mathematically proves that real institutional capital aggressively entered the market and completely shattered previous swing highs or lows.
Now, for Rules 2 and 3, we define the mitigation zone very strictly, from the open of the lowest bearish candle all the way down to its absolute lowest wick. But here's the catch. You don't just blindly buy the open of that candle. Institutional algos love to retest deeper to grab maximum liquidity. So you have to set your limit order precisely at the 50% equilibrium midpoint of that wick to open zone. This is exactly how you let the market come to you.
Rule 4 is basically your shield. Remember, algorithmic systems hunt at the edges. They hunt the wicks. If you put your stop right on the order block wick, you are literally painting a target on your back. Instead, you take the extreme low of the order block wick and subtract a protective buffer of 0.5 times the current 14-period ATR.
This single mathematical adjustment keeps your trade safely tucked outside the main zone of algorithmic manipulation.
It's crazy when you look at the stark contrast between these two approaches. On one side, you have the retail mindset. It's purely emotional FOMO, chasing those massive green expansion candles, placing stops completely blindly, and just suffering constant psychological whiplash. But on the other side, the institutional mindset. It's calm, it's predefined. Elite traders just sit patiently, waiting for the price to drift back to that origin mitigation zone, and they enter with mathematically buffered risk. It is night and day.
Which brings us to Section 4, the inversion model.
Let's be real for a second. Markets are probabilistic. Not every single order block is going to work out. And when support fails, what do retail traders do? They panic. They average down, they pull their stops, and they just pray. Institutions literally feed on this vulnerability. The second an order block fails, which means a candle body closes firmly beyond that extreme wick, sentiment flips instantly from accumulation to distribution. And when the price inevitably retraces back up to that failed block, trapped retail buyers get this false glimmer of hope and try to exit at break even. That exact moment is when institutions dump their trapped inventory onto those hopeful buyers, turning former support into brand new inversion resistance. To trade this, you just wait for the structural close and set a short limit order right at the bottom edge of that newly inverted block.
Section 5. Multi-timeframe alignment. Now, even with all these rules locked in, the research warns about one fatal amateur mistake: single timeframe tunnel vision. Institutional algos run on a very strict hierarchy, which means you need a two-step top-down filtering rule. First, you have your macro anchor. You start exclusively on the daily or 4-hour chart to find your primary institutional bias zone. You never ever fight this macro trend. Once the price hits that zone, you move to the micro refinement phase. You drop all the way down to a 15-minute chart and just wait for a nested order block to form inside that higher time frame zone. This sniper-like entry lets you drastically shrink your stop loss while basically riding the coattails of multi-million-dollar momentum. It absolutely skyrockets your risk-to-reward ratio.
Finally, Section 6, trading like an institution.
All right, we've gone through the mechanics, the math, and the time frames. Let's pull the whole shebang together to cure that habit of improvisational trading once and for all. Here are the 4 core pillars of statistical inventory management that you can start auditing your trading journal with today. Pillar 1, macro bias. Never fight that higher time frame trend. Pillar 2, objective displacement. Always demand an impulse greater than 1.5 ATR. Pillar 3, equilibrium entry. Execute strictly at the 50% midpoint of the mitigation zone. And Pillar 4, volatility stop. Always pad your stop with a 0.5 ATR buffer right outside the extreme wick.
When you actually combine these incredibly strict mathematical rules with the multi-timeframe approach, the whole psychological burden of trading just starts to evaporate. You literally stop caring about the outcome of any single random trade because you know for a fact that your statistical edge will play out over a sample size of 100 trades. So the final question the source material leaves us with is this: are you going to keep acting as exit liquidity for the big banks? Or are you finally ready to drop the emotional bias and execute with cold, hard, institutional mathematics? The trajectory of your trading is completely in your hands. Thanks for hanging out with me for this explainer.